Namaskar, hello and welcome friends to Finnovation, your one-stop solution for CFA exams. My name is Shrishmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is part of the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
So friends, welcome to this new chapter of CFA Level 3. It's the part 2 of capital market expectations, and the chapter's name is Forecasting Asset Class Returns. So when it comes to forecasting, there are primarily two things that we are looking to understand. One is the risk and the other is the return. One is the risk and the other is the return. Now, what are the metrics through which risk and return can be measured? Obviously, risk has multiple matrices like variance is there, covariance is there, standard deviation is there, all these things. Beta is there. These are measures of risk. But asset classes are more popularly targeted or more acceptably targeted in terms of returns. We are looking at the expected returns of asset classes. This is one of the most important matrices when we are trying to allocate assets and design portfolios, right? So here our main focus will be understanding how to measure expected returns of an asset class or multiple asset classes, and in terms of risk we'll also talk about variances and covariance metrics, right? So let's get started. Asset class forecasting methods. How many ways are there in which asset class returns can be forecasted? Now here, on a higher level, there are three ways in which asset class returns can be forecasted. One is judgment. Judgment means one is trying to use their own subjective experience, own rationale and intelligence to understand what the future holds. Then there are formal tools. Formal tools means they are based on mathematics, they are based on statistics, and based on these kind of models, we are trying to predict what the future holds. Then comes surveys. Now surveys are basically asking questions to the participants in a market or the high stake participants in the markets, what they think about the markets. And based on them, and based on those opinions, trying to create a consensus, and based on that consensus, trying to predict what the market holds in the future, right? Because if somebody is a significant participant in the markets, the actions taken by them themselves are going to influence the markets, and their own understanding also is likely to be much more objective and closer to the true sense of things, right? Now, judgment and surveys we have already understood. There are no formal ways of doing this. It is very subjective, judgmental, as the name suggests. We come to formal tools after this. The formal tools are basically based on statistics and mathematics. Now there are primarily three ways in which the formal way of forecasting is conducted. One is statistical methods, another is discounted cash flow methods, and the third one is the risk premium method. Now one by one, let us briefly discuss all these methods. First, we'll talk about the statistical methods. In terms of the statistical methods, the first way in which a kind of return or forecasting can be done is through mean, variance and correlation combination. So let's say right now you have the data of a market, and in the future you have multiple possibilities. The returns can be, let's say, 20%, it can be 22%, it can be 18%, it can be 16%, 14%, 25%. Like this, you create a distribution which is based on probabilities or some other parameters. Let's say you are correlating the returns based on the market conditions, you are correlating the returns based on the interest rate paths, etc., etc. Based on that, some distribution can be created. Some distribution like this. Let me do some rough work here. Some distribution like this can be created, or a skewed distribution like this can be created, or a distribution with kurtosis can be created like this, right? So based on these kind of distributions, you then create further measurements to predict what the future holds, right? Actually speaking, in practical terms, judgment and models and surveys, all these things can be combined together to create market opinions, right? Because the distribution gives you a reference point, your own experience and own judgment gives you a finer understanding of what those distributions may look like in the future, a sharper idea of what those distributions may narrow down to in the future. Then surveys basically are for reconfirmation of those judgments, right? Now the next method under the statistical methods is shrinkage estimate. Shrinkage estimate is basically trade-off of two contrarian judgments. Shrinkage estimates are basically trade-offs of two contrarian judgments. Let's say you are thinking the future is going to be very good, and the alternative option is the future is going to be moderate or very bad, right? Now, based on your judgment of circumstances, you attach weightages to it. Let's say you attach that the future is going to be very good with a probability of 50%. It's going to be moderate with a probability of 30%, and bad or very bad with a probability of 20%. Now, based on each of these assumptions, you create separate statistical measures or forecasts, and then you create a weighted average of those forecasts. This kind of method will be called a shrinkage estimate, right? What is a time series method? A time series method is basically, let's say your hypothesis is that the current price of an index, a stock market index, is basically a function of the previous 1 year of daily closing prices of that same stock market index. So it is basically a function of the price from 1 year earlier, that is -1, till now, that is 0, right? So there are approximately 365 days minus the number of holidays. These many data points you are looking at to project the price of the current times, right? That is your hypothesis. So here what you are doing, you are basically using the same variable in a lagged time to find out the future forecast. So for you, the price tomorrow, let's say P1, is a function of P0, that is price today, and previous 365 days of trading prices, right? Minus the number of holidays, obviously. This is your hypothesis basically. So you are using lagged data of the same variable. For you, price at time t is a function of price at t minus 1, price at t minus 2, price at t minus 3, ... for 1 year, right? This is your thesis. Now this is called a time series. You are using the same variable with a lagged time as the variable which will predict the future value. So you're using the same variable value in the past to project the future. This is called a time series evaluation. So we have understood the three methods: mean variance correlation, shrinkage estimate, which is basically weighted average of different possibilities, and time series, which is basically past values of the same variable to use the future value of that very variable. Now we'll go into risk premium models. Let's understand what they are. Let me remove the rough work here. Now under the risk premium model, there are again three ways of doing it. One is an equilibrium model. An example of an equilibrium model is CAPM model, right? Capital asset pricing model. We have all understood that in the previous levels, which is risk-free rate plus beta into the market premium. Then the factor model. The factor model can be based on multiple market-based models, fundamental models, or technical models. Basically, you are trying to create an equation like this: y is equal to a plus a1 x1, where x1 is one of the variables, one of the factors, then a2 x2, like this. This is a linear factor model, you can say. Or we can use an exponential or a polynomial factor model also, where y is equal to e to the power a plus a1 x1 plus a2 x2 plus ... like this. So these are basically factor models. Then comes the building block models. Building block models basically has four segments. First you begin with the risk-free rate, then you add the term premium to it, then you add the quality or credit premium to it, and then you add the liquidity premium to it. So what it is? Basically the risk-free rate plus the term premium, that is time, because of time difference what the rate happens. Let's say a government bond of 3 months maturity and a government bonds of 10 years maturity. Although they have the same quality and the same issuer, which is the government, they are default free, still they may have different rates, and that rate is considered to be a rate difference because of the term difference, that is the time length difference. So this is term premium. Plus you add the quality difference, let's say credit premium. Let's say you're comparing a corporate bond of 10 years with a government bond of 10 years. Now the difference between these two is basically a difference of quality. And one of the ways to understand the difference of quality is the credit quality. Let's say the government bond is AAA rated and the corporate bond is rated AA. Now there is a difference in the credit quality, and based on this credit premium can be understood. We will go into further details of it. Then comes the liquidity premium. The liquidity premium. Let's say we are trying to compare two bonds having the same credit quality, two corporate bonds having the same credit quality. Both of them, let's say, are AAA. One is a bond X, one is a bond Y. Both have AA ratings, right? AA ratings. Both have the same maturity. Let's say 10 years both. 10 years for both. Now one of them trades n times per day. One of them trades 2n times per day. Now there is a difference in liquidity. That is, the number of times hands are changing of a bond is different. One is trading n times per day, one is trading 2n times per day. So that one which is trading n times per day will have a higher liquidity premium. So this is what we mean, simply speaking, by the bifurcation of the building block. The first is the default free rate or the risk free rate, RF. Second is the term premium or RT. Third is the credit premium or credit quality premium, you can say. This is RC. And the last one is the liquidity premium, RL. Right? These four factors together form what we call the building blocks method. So friends, this is so much about our statistical model and risk premium model. Discounted cash flow models are a different way of doing it. We are trying to understand the future cash flows first. The cash flows that are coming in the future. It can be a business, it can be a bond coupon, it can be anything, it can be interest rate, it can be dividends, it can be capital gains, whichever one. And the future cash flows, from the future cash flows, we are trying to find out the present values based on some discount rate. Right? Now this discount rate, how we are arriving, the cash flows, how we are predicting them, this is all about understanding what discounted cash flows are. So we have briefed about the three methods under the formal tools, and this is going to be our core discussion from here on in, the formal tools, the discounted cash flow, the risk premium models, etc., etc. And this is going to be discussed under the headers of different asset classes. So we will understand how to project the returns of a fixed income instrument, equity instrument, etc., etc. So let's get started. Return forecasting for fixed income instruments. Now friends, when we are trying to forecast the returns of fixed income instruments, especially plain vanilla instruments where embedded options are not there, a very important tool is discounted cash flows. We want to understand the returns through discounted cash flows, right? Now, the level of granularity depends on the kind of precision that is required. Let's say you are trying to do asset allocation. There is one level of precision which is required here, but an even more greater amount of precision is required when you are trying to do things like rolling down the yield curve or understanding the future yield curve shape. In these cases, much more precision or micro precision is required, right? And depending on that, you apply different methods or different granularity levels. Now next we try to understand how we can proof our investments or protect our investments from the fluctuations of interest rates. Interest rates keep on changing, right? 3 years back it could have been near zero. After 2 years it became around 4%. Then again it may come down in the future, right? These fluctuations keep on happening, and we not only want our equity investments to be protected from these kind of fluctuations or at least have a hedging option there. We also want to know how we can protect our fixed income instruments from these kind of fluctuations. This is assuming that you are not trying to speculate where the interest rate is going and benefit out of that. You just want to hedge yourself from either kind of fluctuation, either increase of interest rates or decrease of interest rates. Now, when you are invested in a bond, in a plain vanilla bond at that, what is happening is you are getting coupons in a periodic basis, right? Coupon. At the end of the term, let's say you will get the initial principal plus the coupon, right? This is how the payments are happening. Now you are getting these payments and you have to reinvest them also to maintain your investment levels at the optimal or the maximal level. Now, when the interest rates are going up, your reinvestment of these coupons are gaining much more, right? When interest rates are going up, your reinvestment returns are actually benefiting from it. But if interest rates are going up at the same time, your capital gains are not that much, or in fact, you might be losing capital, right? Let's say you bought a bond when the market rates were 5% at a certain rate. Now, if the rates become 8% or 10%, obviously your bond price has fallen, so you have made capital losses. On the other hand, if the market rates are falling, then your current bond that you have already purchased at 100 rupees when the market rates were, let's say, 5%, if the rates fall to 2%, your bond becomes more valuable in the market. So you have capital gains. If interest rates fall, you have capital gains, right? Now, in both the cases, the key factor to look at is the holding period. The holding period and the holding period. What is the holding period? Basically determines what you are exposed to. Are you exposed to falling of interest rates? Are you exposed to rising of interest rates? Are you going to benefit due to rising of interest rates? Are you going to benefit from falling of interest rates? Or have you hedged both these kind of fluctuations? This is what essentially matters. Now, how much should be your holding period? We begin with this factor, that how much should be your holding period so that you neither gain nor lose due to changing of interest rates, because you want to avoid volatility, right? This is assuming you want to avoid volatility, you want to hedge your probabilities. For that, what is the holding period required? That holding period is exactly equal to the Macaulay duration of the fixed income instrument that you have taken. And it's a plain vanilla instrument that we are talking about. So it's a Macaulay duration. Holding period should be equal to the Macaulay duration of that particular instrument. And here we are limiting ourselves to plain vanilla instruments, right? Macaulay duration. Now, what happens if your holding period is equal to the Macaulay duration? Your change in reinvestment return is equal to the capital gains or losses. Capital gains or capital losses. So, if you are gaining in the interest part or the reinvestment part, you lose in the capital part. If you gain in the capital part, you lose equally in the reinvestment part. If your holding period is exactly equal to the Macaulay duration, this is what happens. Now, what happens if your holding period is greater than the Macaulay duration? Obviously, you are holding the bond for a longer period of time. You will be getting periodic payments or coupons for a longer period of time. So here you are exposed more to the reinvestment returns than to the capital gains or capital losses. So here, if interest rate rise, you gain more. Right? Why? Because in this case, the reinvestment return impact on your holding period or on your portfolio is greater than the impact of capital gains or capital losses. On the other hand, if interest rate fall, you lose. You lose if interest rate falls. Same reason, because your reinvestment returns are more impactful to your portfolio than the capital gains or capital losses. In this case, you will be having capital gains, but that capital gain will be more than overshadowed by the reduction in your reinvestment returns, right? Then what about the third case, that is holding period less than the Macaulay duration? In this case, the reverse is happening, friends. Here, you are looking at having less coupons received and gaining more from capital gains, right? So you are more dependent on interest rate falling. So if interest rate falls, you will gain. You will gain if interest rate falls, because here the reinvestment returns are not that important. It is less important than the capital gains, right? On the other hand, if interest rate rise, you will gain due to change of reinvestment returns. Your reinvestment returns will increase, but that is less important than your exposure to your capital gains or capital losses. So here you will lose more due to capital losses than the gains that you make due to your reinvestment of coupons. So here you lose. So this is how it plays out. And if you want to balance both, you do not want to benefit either from capital gains or from reinvestment returns, keep your holding period equal to the Macaulay duration. And here the assumption is very important. Remember, it is plain vanilla investment. You are looking at a fixed income instrument without any embedded options or convertibility or warrant right, etc. Right? The building block approach for fixed income instruments. So building block, as the name suggests, you are basically building a first block, then on it you are building the second block, then on it you are building a third block, and so on. And in this approach, you actually have 4 levels. The first level is the default free rate. The first level is the default free rate. Now, this is usually a government bond with a certain level of maturity. More generally, it's a 3-month treasury bill, right? This can be a reference for the default free rate. And this is very much under the control of the central banks. So, this is generally used as a default free rate, specifically for fixed income instruments. Then the next block, which lies above it, is the term premium. Now this second block is basically variability of rates or required rates or risks or changes in risk due to change in maturity. And as the maturity grows, that is a 10-year bond is considered to be more risky than a 3-month bond, even though their qualities and their issuers or their reputes might be the same, right? The third block is the credit premium. Now this is, here we are talking about the credit quality and the credit spread and similar things. So let's say you have a 10-year corporate bond that you want to invest in and you are trying to compare it with a government bond. Now what you will do? You will compare it with a government bond of 10 years, let's say. So let me show it here. You are trying to invest in a 10-year corporate bond. You compare it with a 10-year government bond, and you see that this bond, corporate bond, has a rating of BBB, while the government bond has a rating of AAA. Now based on this, there will be a premium. This premium is called the credit premium. Now if you have to break down the 10-year government bond rate into term premium and default free rate, obviously you compare this 10-year government bond with a 3-month government bond, right? Because we considered here that the default free rate is for the 3-month bond. So 3-month government bond, let's say, has a rate of 2%, and the 10-year government bond, let's say, has a rate of 4%. So you decide that the default free rate is 2%, the term premium is 4% minus 2%, which is 2%, right? 2% is the term premium, and this 2% is the default free rate, the 3-month government bond rate, right? The corporate bond, let's say, has a yield to maturity of 6%, and here we assume that there is no liquidity premium. So here the credit premium will be 6 minus 4 or 2%, right? Now we come to the fourth block, which is the liquidity premium. The liquidity premium basically depends on the demand of the bond and the supply of the bond, comparative demand and supply of the bond. Let's say a bond is traded n times a single day, and another bond is traded 2n times a single day. Here the bond which is trading n times is actually having less liquidity, so this will charge a separate or a higher liquidity premium. So this is what we mean by the liquidity premium. Generally, liquidity premium and credit premium are clubbed together for investable bonds or corporate bonds or high yield bonds. Separating them out is a little tricky, but we'll consider that in the next section. Here we are trying to understand what default free rate is, what term premium is, what credit premium is, and what liquidity premium is in a simple way. Now one by one, let us discuss them in a bit of a detail. So let me remove the rough work here. Now how do you ascertain the default free rate? First we consider general scenario, that is, rates are not in a special condition like non-zero rates or super high rates like that. It's a general scenario of normal interest rates, normal yield curves, generic yield curves. In this kind of a scenario, what you do is that The short-term government bond rates, which changes every 3 months or which is reconsidered every 3 months, is taken as the default free rate, right? Every 3 months this is reconsidered, and this is very much under the control of the central bank or Fed. In case of USA, it is the Fed, right? This is the default free rate under general conditions. But what if there is a special scenario? For example, there is a negative interest rate situation. In this case, obviously, you have to change other premiums and normalize this default free rate. You have to normalize this default free rate. So for example, if you consider that interest rates are negative, that means the growth prospects or the general expectation of growth is very, very low, and people are looking for quality assets or safe assets to invest in. So the amount of fear in the markets is very, very high. So that kind of premium can be added to the default free rate when considering this kind of a special scenario, right? One more variation can happen when you are considering longer forecasting horizons. For example, it can be 3 years, 5 years, or 10 years, or whatever. In that case, you do not use the current 3-month bond. You generally do not use the current 3-month bond. You replace that with a maturity matching zero coupon bond. That is one way of doing it. Maturity matching zero coupon bond. That rate you take as the default free rate. If you are looking for a 10-year bond, you match it with a 10-year zero coupon bond. If you are looking at a 5-year bond, you match it with a 5-year zero coupon bond. Likewise. The other option is doing a path projection of the 3-month rate 10 years down the line. Doing a path projection of the 3-month rate 10 years down the line. This can be calculation of forward rates, prediction of the future volatilities, future economic conditions, future various probabilities of pathways and weighted average and all that. So this is a much more complicated option. Through path projection, we can also do that. Now, let us discuss term premiums. How do we ascertain the term premiums? One way is to calculate it through calculating of forward rates. So let's say you are having a 3-month bond as a reference. You want to calculate the term premium for a 6-month bond. What you do is you just calculate the forward rate 6 months down the line, and the difference you calculate as the term premium. Let's say the 3-month bond is 2% and the 6-month bond through forward rate calculation turns out to be 3%. So the term premium here becomes 3 minus 2 or 1%. This is one way of calculating it. The second way and a more pragmatic way of doing it is evidence based, because while you are calculating the forward rates, you are assuming that the yield curve does not change or the economic conditions does not change, the expectation of the economic conditions does not change, etc., etc. There are many rigidities in the forward rate calculation here. Although it is simpler and more precise, having a look of a more precise conclusion, still yield curves do not remain constant over time. So we have to take evidence-based approaches. Evidence-based approach suggests that yes, the maturity or the term is important. It is a vital factor for deciding the rates or the spreads, and it depends on the duration. It depends on the duration. So term premium is an important thing, or the term or the maturity is an important thing, and it depends on the duration of the instrument that we are looking at, right? Now, Ilmanen in the year 2012 observed a 4-factor approach on the term premium. The first factor was level and uncertainty of inflation. So what is the current level of inflation and what is the level of uncertainty of future inflation? That influences the term premium. Obviously, higher the level and uncertainty of inflation, higher will be the term premium. And both of them increase or decrease together. The levels of inflation, if they go up, the uncertainty of inflation also goes up, generally speaking. And if the levels come down, the uncertainty also comes down. So they go up and down together. The second factor that Ilmanen observed is assets' ability to hedge recession risk. So if there is a 10-year bond which is considered to be very high quality, let's say a government bond of a developed country, in that case, the term premium can be very minimal. On the other hand, if it's a government bond of an emerging market which does not have a very good reputation, then a 3-month bond can have a very different rate than a 10-year bond. The rates for the government bond itself can be very, very different. Then the third factor that Ilmanen observed was supply and demand, that is maturity based supply and demand. Generally, the shorter the maturity of a bond, the greater the demand the bond has, which implies they have the lesser term premium. The higher the demand, the lesser the premium that is required to be paid. Fourth factor is the phase of the business cycle. So if it's a contraction phase, obviously high quality bonds might have much higher demand, which will mean that their premium will become lower. On the other hand, if it's an expansion cycle which is going on and things are looking pretty good, then the premium may look quite high because the demand is low and the yields are high. Then we come to the credit premium. Now we have spoken about default rates, we have spoken about the second block, which is the term premium. The third block is the credit premium. So what are the factors which ascertain the credit premium? Let's understand that. One thing is, credit spread is a very good measure of the credit premium. The information of credit premium is found in the credit spreads. This is what empirical research suggests. And credit ratings are a very good reference point to understand the credit spreads, because the higher the ratings, the lower are the spreads, right? Now, credit ratings have a few features. This will help us understand how the credit ratings influence the credit spreads. The first feature of the credit ratings is that it has a downgrade bias. Downgrade bias means, let's say a bond is rated at AA and the rating above it is AAA, the rating below is single A. Now, studies suggest that there are much higher probabilities that the bond may become single A rather than it become AAA. The probabilities of downgradation is higher than upgradation, right? That is why if upgrades happen, you will see if a listed business or a sovereign entity gets upgraded by a reputed credit rating agency, then its valuations increase and it attracts a lot of capital. Second point is, spreads vary cyclically. During a contraction phase, the spreads tend to widen. And during an expansion phase, the spreads tend to narrow. That means higher yield bonds are available at comparatively lower rates or lower premiums. When the markets are moving upwards or expanding, the spreads move downwards, and when the markets are contracting, the spreads move upwards. So it's kind of a counter-cyclical movement. Point 3. Spreads increase at an increasing quantity or value. That means spread between A and AA is more than the spread between AAA and AA. This is less. So if you see in a curve, if the AAA bond curve looks like this, the AA looks like this, the single A will look something like this, right? So the AAA is here, the AA is somewhere here, and the single A is somewhere here. So here you can see the spread is wider between A and AA compared to AA and AAA, right? This is the third point. The fourth point, default rates are directly proportional to loss severity. So when the markets are in a contraction mode, what happens is many bankruptcies happen. Many loans default during that time. And because there is a secular decrease in the asset prices, the loss severity is also very high because recovery is much less, right? And the fifth feature is short-term preference. So premiums are much less for shorter term bonds. Premiums are much less for a shorter term bond. So let's say if it's a single A rated bond and it's a 1 year bond, this will have a much less credit premium than a single A rated bond with 10-year maturity, right? Short terms will be preferred in terms of credit premium also, not only in terms of term premium. In terms of credit premium also, shorter term is preferred more. So premiums are less. The short term means premium is less, credit premium is less, right? Then we talk about liquidity premium. Liquidity premium also depends on certain factors. First factor is its recency of issuance. An on-the-run bond, which means a recently issued bond, An on-the-run bond, which means a recently issued bond, has much less liquidity premium than an off-the-run bond or a bond which has been issued months back or even years back. Quality preference. A high quality bond will have much more liquidity than a comparatively lower quality bond. Issue size. A large issue generally has a higher liquidity than a smaller issue. Reputation of the issuer. This is the fourth point. A well-known issuer, even if it's a corporate issuer, will have much higher liquidity than a new issuer or a less reputed issuer, right? Simple structure. The simpler the structure, the less the complications and embeddings, the more the demand or the more the liquidity of the bond. We move on. Now we have understood all the 4 blocks of the building block. We'll move into the next section and understand the specific factors that one has to be concerned when dealing with emerging market fixed income instruments or emerging market bonds. Risk specific to emerging market bonds. There is basically a twofold risk involved here. One is economic risks and the second is political and legal risks. Economic risks and political and legal risks. Not all the emerging countries have same intensity of risks, but the factors have to be taken into account when you are trying to analyze an emerging market instrument. So first we'll understand what are the economic factors and then we'll understand what are the political and legal aspects. So first we'll talk about the economic risks. What are the economic risks in an emerging market? There are probabilities of greater wealth inequality, which means the rich and the poor have a great amount of difference. This can be one of the factors. Second factor, dependence on very few industries. Let's say an emerging market country is solely dependent or highly dependent on mining resources or on oil and gas. Now, one should be concerned while investing in that. Then restrictions on trade, capital flows or currency conversions, right? So, you have to consider what are the exchange rate scenarios, what hassles one has to face when trying to exchange the currencies. What are the hassles one has to face when doing foreign direct investment or investing in that country or taking out the capital from that country? And what is the liquidity scenario of that country? And what are the trade relations of that country with the foreign nations? Right? The fourth factor, poor fiscal controls and monetary discipline. Poor fiscal control means huge amount of deficit spending, and monetary policy poor means the interest rates can be unstable, the inflation can be unstable, money supply can be unstable. Human capital issues, skill levels of labor, knowledge levels of labor, experience levels of labor can vary. Infrastructure infrastructures can vary. Technologically, the nation may be lacking. These factors you have to check. Foreign borrowing in excess, foreign currency borrowing or foreign borrowing in excess. This is another factor which can be alarming. Smaller financial markets, the total market cap of the equity markets, the total trading volume of the bond markets, all these things also matter. And the size of the institutions, like size of the banks, size of the financial institutions, these also matter. So one has to take them into consideration also. Probability of capital flight. Foreign investors who are investing in emerging markets are very wary of other foreign investors taking out their capital. And this kind of a consensus building can actually be a self-fulfilling cycle. So probability of capital flight in a certain country has to be taken into consideration. What are the threshold numbers? If you have to quantify all these factors, what are those numbers that you should be concerned about? So first is debt to GDP ratio. Debt to GDP ratio should not be more than 70 to 80%. For a developed country, it can be more, it can be 90, 100 or even more in percentage. But for a emerging market nation, it should be 70 to 80% at max. Then persistent real growth should not be less than 4%. This is another concern. Persistent real growth has to be more than 4%. Third factor of concern is persistent current account deficits of greater than 4%. This is also something you do not want. It should be less than 4%. Current account deficit should be less than 4%. Then foreign debt Foreign debt should not be more than 50% of GDP. Foreign debt should not be more than 50% of GDP for an emerging market entity. Fifth factor, foreign debt should not be more than 200% of current account receipts. Foreign debt should not be more than 200% of current account receipts. Lesser the better. Sixth factor, forex reserves should be greater than the amount of short-term debt. A forex reserve which is less than 100% of short-term debt is considered concerning. Next, political and legal risks. We have so far discussed the economic factors. Now we'll discuss the political and legal factors. So first is weak property rights. Weak property rights means the contract laws are weak. The enforcement is also weak. This factor you have to check into account. Then political instability. Political instability can be due to many reasons: frequent elections, coalition governments, instability in the political system. All these factors have to be taken into account. Law enforcement issues. There can be written laws, but you need a entire system in place to enforce them. There can be issues there. Sovereign immunity principle. Once a country releases a lot of debt, it is not like an individual. Issued by a sovereign entity can be much more difficult to take than debt issued by an individual or an business entity, right? So this factor you have to take into account. Confiscation of property. Let's say a foreign investor invests in an emerging market property. Let's say it can be a commercial property or stock or whatever, but that ownership itself can be deemed illegal. It can be due to geopolitical shifts. It can be due to political reasons. It can be due to multiple factors. So this factor has to be taken into account. Nationalization of companies. So too much nationalization is a point of concern which should be taken into account. Corruption at different levels of politics, levels of administration, levels of bureaucracy, levels of business. All these things have to be taken into consideration. Reparation issues. You want to take capital gains, you want to take the income. At that time, what are the reparation conditions? What are the contractual agreements? You have to take that into account. And what is the viability, or what is the level of trust that you can put on that entity? You have to take that into account. So all these factors also are very, very important when you are trying to invest in an emerging market economy. Forecasting equity returns. So just like we learned about forecasting fixed income returns, we can actually apply different approaches to aim at forecasting equity returns too. Now primarily in our curriculum we'll be discussing three major ways of forecasting equity returns. The first one is the historical approach, the second one is the DCF approach, and the third one is the risk premium approach. And we'll be discussing each one of them one by one. First we'll talk about the historical approach. Now historical approach basically means you look at the past, analyze the past, detect their features both quantitatively and qualitatively, and then try to judge what is going to happen in the future. Now here there are certain advantages also, like data is already available. You have plethora of data. Historically speaking, if you want to check out last 3 months data, that is available. Last 3 years data, that is available. Last 30 years data, that is also available. So data is available. Distributions can be created and their futures can be measured. So let's say you want to create a daily closing price of a certain stock market index. Now that data can be available for the previous 10 years, 30 years or even 50 years or more, right? So that kind of data you can analyze and you can create a distribution and then measure its features. What is its mean? What is its volatility? What is the variance? What are the standard deviations? All these things you can do. Now the disadvantage of this kind of process is, firstly, the data can have biases. There can be survivorship bias, there can be look ahead bias, then the future can be different. Let's say you create a distribution which has a certain pattern to it, certain mean and certain variance to it, but the future can be completely different depending on the market conditions, depending on the volatility, etc., etc. So the future can be different. The past may not reflect the future itself. Then the mean value is not reliable. Now for example, the P ratio, if you want to analyze the P ratio of the last 50 years, it may be ranging from 5 to 50. I'm just taking a guesstimate here, it may range from 5 to 50. Now the mean may turn out to be somewhere around 25 or 30 or whatever, but that mean value may not be very reliable, because mean value over long periods of time only becomes reliable if the volatility is low. Now here the P ratio may have a volatility from a value of 5 till 50. Now that is not a particularly low volatility, right? So here the mean value may not be that much reliable as to ascertain whether the market is overvalued or undervalued. And frequently it has happened that when the markets have reached below the average value, still it has gone on decreasing further and further during market corrections. And when it has gone into expansion mode, the value has been much higher than the average value. Both these things have happened. So mean value is not reliable. So these are the few features of historical approach. Obviously the historical data can be a reference, but you have to apply your judgment or some model to actually ascertain what is the closest value that can be had as a future projection. Now the next method is DCF approach. Let's understand that. DCF approach is basically discounted cash flow approach. So basically what one does is, the future cash flows are predicted, CF1, CF2, all the periods and their respective cash flows are predicted, preferably till infinity, preferably or theoretically till infinity, and then each of their present values are measured. Present value of the cash flow 1 of the first period, present value of the second period's cash flow. Like this, all the periods cash flows with the help of present value calculation and terminal value calculation are measured, and then they are summed together to get the present value of an equity investment. Now all this hassle becomes much more easier if you have a stable growth rate and you know that growth rate will be lasting perpetually. And when this is the case, you can apply something called the Gordon growth model. Now the Gordon growth model gives you an idea of value with respect to earnings yields or dividend yields on equity. Now this goes like this: value at time 0 is equal to dividend at time 1 divided by cost of equity minus the constant rate of growth that is going to last till perpetuity. This is value at time 0. And what is dividend at time 1? This is D1 is equal to dividend at time 0 multiplied by 1 plus the perpetual growth rate. Now this you can assume when the growth rate is perpetually stable. But in real terms, this may not be the case. There can be multiple variabilities to it. For example, one variability can be the PE ratio or the valuation can change. The market's valuation can change. In times of expansion, the PE ratios are above average. In times of contraction, the PE ratios can be below average. So PE ratios can change. Then share repurchases and share issuances may happen. So the count of share itself or the count of your stake itself can change, right? Then what other things can change? Then the earnings can change. At a variable rate, the earnings can keep on changing. For example, during growth periods or during expansion periods, earnings may be growing at 15%. At the same time, during a period of contraction, for a short period of time, it can degrow, let's say at 5%. This can also happen. And the average can be somewhere around 7 or 8%. The weighted average can be somewhere around 7 or 8%. I'm just taking an example here. So the growth rate of earnings is also there, which means earnings are changing. They are not constant. So all these factors are changing. Now, to incorporate these factors of changes, there is a second model that can be used, which is called the Greenwald-Kroner model. The Greenwald-Kroner model. And this incorporates these kind of changes. The changes in PE, the changes in stock issuance, and the changes in earnings. Right? So here, according to Greenwald-Kroner model, the expected return on equity E in brackets RE is given by D by P, that is the dividend yield. This is the dividend yield plus the increase in earnings, which means it will be minus the decrease in earnings, minus increase in shares outstanding. increase in shares outstanding. Now here, if share repurchase occurs, the value becomes negative. In case of repurchase, the value is negative. And the next value is percentage change in PE ratio. Percentage change in PE ratio. Now if the PE ratio was 10 and it became 11, then the percentage increased. So it increased 11 by 10 or 10%. Right? So this is how the measurement is done. Now this can be interpreted further, friends. Firstly, the change in earnings is basically the change in nominal earnings. So percentage of change in earnings is equal to real earnings growth rate, which is G, plus the inflation rate, which is I. Now this is number one. Number two is net cash flow to the investor. Net cash flow to the investor, this is equal to the dividend yield D by P minus the change in shares outstanding in percentage terms. Now obviously this value is negative during repurchase. This is negative for a repurchase, which implies the cash flow to the investor increases when there is a repurchase. Let's say the dividend yield is 5% and there is a repurchase of 2% of shares. So the net cash flow is 5% minus of minus 2%. This is equal to 5% plus 2% equal to 7%. So the cash flow to the investor is more when there is a repurchase happening. Right? This is the second part. So we have gone through dividend. So we have gone through dividend yield, change in shares and earnings. Now the last part. Last part is basically the repricing component. The repricing component. Now repricing can happen due to many reasons. Let's say a company has been performing very well for last 3 to 5 years. It has been growing at a certain rate. Let's say 20% the earnings are growing at. Now let's say the markets were initially ignoring it because it was a new listed company. They were observing how the stock does. Now after 3 to 5 years of consistent performance, the market notices this company and capital starts flowing in. Now initially, let's say the PE ratio was 10. Then it slowly starts to increase to 20, to 30, to 40, like this. As the company continues to perform well, as the projections look valid, then the PE keeps on rising. And as more investors start noticing it, more research report is being issued, more analysis is being done, more purchases are happening, more trading is happening in the stock and the PE ratio rises. This is one thing. Second thing is, let's say a governance issue happens in the company. And as soon as investors get to know there is a governance issue, the PE of the company starts to fall. Let's say it was a reputed company with a PE ratio of 40. It starts to fall, goes to 20, to 10, to 5 and whatnot. It free falls. So this can be another way. A more general way or a secular way of doing it is, the market itself is expanding and the PE ratio of the entire markets is expanding, right? The PE ratio of the entire market can be expanding. During contraction, the reverse can be happening, that the PE ratio of the entire markets is contracting and obviously the stock you have picked is also going down. Let's say the entire market is in expansion mode. At that time, let's say a stock XYZ that one has selected is also expanding in PE. That can also happen. The reverse can also happen, that the entire market is contracting and as a result, a stock that one investor has chosen XYZ, the PE of that is also contracting. It may not be reflecting on the earnings growth. The earnings growth may still be there, but still the PE itself is going down. This can also happen, right? So percentage change in PE is the repricing component. This is the repricing component. So let me remove the rough work here. So the first component talks about the nominal change in earnings, which means the real change in earnings plus the inflation rate. The next component talks about the net cash flows to the investor, which increases if repurchases of stocks happen. The third component talks about the repricing component or the change in the PE ratio, which happens during different cyclicalities of the business cycle itself or due to some company specific event also this can happen, right? So this is a basic idea of the Greenwald-Cronert model. Now, next we'll discuss about forecasting equity returns based on equity risk premiums. equity risk premiums. The risk premium approach. Now, one of the ways of measuring equity risk premium is to measure the equity returns required with the treasury bill rate. Let's say the treasury bill rate is 3% and the equity return required is 15%. So, based on equity versus T-bills comparison, the premium is 15 minus 3 or 12%, right? Now, let's say an investor is looking to invest for a 5-year horizon, but the T-bill is only 3 months. In this case, what does one do? In this case, maturity matching can be done. So, we do equity versus bonds. So, T-bills are generally government bonds, or T-bills are generally the safest kind of bonds, and government bonds of 5 years are also of the same category in terms of their default safety. So, the only difference is in the term. That is the term length or the maturity length. So, this is basically, now you add the term premium with the T-bill rate and subtract it from the required return in equity. So, this is equal to equity required returns minus T-bill rate minus term premium. So, 3 months versus 5 years, whatever the excess term premium is there, you subtract that further. Let's say for a 5-year bond, the term premium is 2%. The T-bill rate is 3% and the equity's required return is still 15%. So, in this case, the value is 15% minus 3% minus 2% is equal to 10% equity risk premium, because you are doing a maturity matching, and for that you are adding the term premium to the T-bill rate and then subtracting the total from the required rate in equity. Right? So, we have discussed equity versus T-bills, we have discussed equity versus bonds. Now, the next method is the equilibrium approach. Now, by equilibrium approach, what do we mean? By equilibrium approach, we mean that the basis of these models are that the supply and demand of capital are in balance and the risk and reward of an investment are balanced. That is, more the risk, more the return, or less the risk, less the return. More the demand, more the supply of capital, less the demand, less the supply of capital. So, these opposing forces are balancing each other and they are remaining in a balanced condition. This is what we mean by equilibrium approach, and the assumption is that the markets are in equilibrium, and based on that these models have been created. Now, CAPM, we already know, CAPM means return in an investment is equal to the risk-free rate RF plus beta of that investment with respect to the market multiplied by the difference between the market required return and the risk-free rate, that is the market premium, right? This is what CAPM model is. Now, this is a single period equilibrium model. Now, in this model, this beta that we have is assuming that the markets are perfectly integrated. The CAPM assumes that the markets are perfectly integrated, which means the capital flows, the exchange rates, everything are free floating. The capital flows are free, the exchange rates are all floating, and the entire system is in equilibrium. So, these are the assumptions. But in reality, there are certain variations. For example, any nation or country, no matter how much free trade they are having, there are certain degrees of constraints there. It can be industry specific, it can be some other nation specific, it can be based on geopolitics, it can be based on economics, whatever. But there are certain degrees of constraints most of the times. Now, this variation in the level of market integration is incorporated in something called the Singer-Tehran model. The Singer-Tehran model. They incorporate this variability that the markets are integrated to a certain extent, and to a certain extent they are also segmented, right? And this degree of segmentation and degree of integration may vary from entity to entity, nation to nation. So let's say the entire market is a global market which is given by the suffix GM, and the market segment of our interest is given by I, right? It is given by I. Now the equity risk premium for this market segment I is given by the sum of two factors. One is the degree of integration with the global markets multiplied by the beta of this market segment with the global markets multiplied by the Sharpe ratio of the global markets. This is one factor, plus the degree of segmentation. The degree of segmentation 1 minus phi multiplied by the beta of that market segment with itself multiplied by the Sharpe ratio of that market segment. The Sharpe ratio of that market segment. Equity risk premium of the market segment I is equal to level of integration phi multiplied by beta of the market segment I with respect to the global markets multiplied by the Sharpe ratio of the global markets plus level of segmentation 1 minus phi. This is the opposite of integration with the global markets. 1 minus phi multiplied by beta of the segment of the market of our interest with itself, which is 1, multiplied by the Sharpe ratio of that market segment. Now this can be rewritten in the following way. Now beta of the market segment I with global market is given by the risk premium approach. So here we'll talk about three specific approaches. The first approach is the equity versus treasury bills approach. Here what you do is simply, you know your equity required return, let's say it's 15%. From that you subtract the current treasury bill rate. So let's say it's 3%. So your equity risk premium becomes 15 minus 3 or 12. So this is equity return required minus the treasury bill rate, simply put, right? This is the first way of doing it. Now let's say an investor wants to invest in equity for 5 years. The holding period is 5 years. Then what should be done? Then the appropriate way is matching the maturities. And one way to do that is subtracting the term premium from the previous equity risk premium additionally. So which means equity return required minus the T-bill rate minus the term premium. So let's say you have a holding period of 5 years. You look at a default free bond of 5-year maturity, and let's say that bond has a term premium of 3%. So the T-bill rate is 3%, the term premium for the 5-year maturity is 3%, and the equity return required is 15%. The equity risk premium is 15% minus 3% minus another 3%. Result is 9%. So this is equity versus bonds. And this is in the case where the holding period is different than the maturity of the T-bill rate, preferably. The next approach is equilibrium approach. Now there are two methods to it. One is the CAPM approach, which is a simpler method. And then there is Singer-Tehrar approach, which accommodates a certain degree of excess variability also. We'll look at which variability it accommodates, and first we will discuss what is the CAPM. So the CAPM, we have already known about it. Let's say we are interested in an investment I. It can be a particular industry, it can be a particular company, it can be a market segment or a country. Preferably in our discussion sense, we are talking about a country. So let's say I is a country of our interest, and the return required when you invest in country I is the risk-free rate plus the beta of I with the global markets represented by M here multiplied by the return in the global markets minus the risk-free rate. Return in the global markets minus the risk-free rate. Now this is assuming that the markets are fully integrated. The CAPM has an assumption that the markets are fully integrated, right? But in reality, the markets most of the times may not be fully integrated. No matter how free the capital flows are, there can be certain constraints which can be due to economic reasons, which can be due to geopolitical reasons, etc., etc. So the equity risk premium, that is the second segment, the difference between the risk-free rate and the market rate, which is the equity risk premium, is bifurcated into two parts. One is the equity risk premium of the global markets, and the second is the equity risk premium of the individual market segment or the country or the state that you are looking at, right? Now that is given by suffix I. The micro market of our interest is suffix I and the global market is GM. The equity risk premium of the global markets is given by ERP-GM. Now you have done this bifurcation. What is the next thing to do? The next thing is you incorporate the betas just like you did in the CAPM. So you multiplied the risk premium of the global markets with the beta of the micro market of your interest with respect to the global markets. So beta of I with respect to GM. This is what you multiply this with. Then you multiply this with another factor, which is the level of integration. The level of integration is given by this symbol. It's called phi. The degree or the level of integration. Let's say it is highly integrated. Then this value will be close to 100% or close to 1. It can be 0.85, 0.9, 0.8, 0.95, like that, if it is highly integrated. If the integration is much lower, it can be 0.2, it can be 0.3, it can be 0.4, etc., etc. If it's moderate, it can be 0.5, 0.6, 0.7, etc., etc. So this is basically the degree of integration with the global markets that your market of interest has. This is represented by phi. Now this is the first part. This is the first part of our equation. We are building the equation. Just stay with me. We are building the equation. We'll understand it at the end of it, how the equation is built for the Singer-Treheran model. Now this next part. The next part already we know. The next part has the equity risk premium of the market of our interest, that is ERPI. What do we do with it? We multiply it with another beta. This time the beta is the beta of the market of our interest with itself. So it is beta of I with itself, right? Beta of I with itself. Now this is multiplied with the level of segmentation, the level of segmentation of the market. So let me move it a little sideways here. We move it a little sideways and we multiply with the level of segmentation. So level of segmentation is basically 100% minus the percentage of integration. That is, this is equal to 1 minus phi, right? Or we can write it 100% minus phi if phi is represented as percentage. Generally it is represented in decimal terms. So 80% means 0.8 here. So it is 1 minus phi, right? So we write here 1 minus phi. This is our second part of the equation. So we are basically taking the weighted average of two risk premiums. We are getting our resultant equity risk premium, which is based on these two risk premiums weighed in a certain way, right? This is our resultant equity risk premium based on Singer-Treheran model. This equation is called the Singer-Treheran model equation. Now this expression can be made more simpler, friends. For example, the beta can be modified. Beta of I with respect to global markets is actually equal to covariance of I with respect to global markets divided by variance of the global markets, right? Now beta of I with respect to global markets, if you multiply this with respect to equity risk premium of the global markets, then this is equal to covariance of I with respect to GM divided by variance of the global markets root, or the standard deviation multiplied by equity risk premium of the global markets ERPGM divided by standard deviation of the global markets. We have just taken the variance and divided into standard deviation into standard deviation. That's what we have done, and we have put the second part in the brackets here. Now interestingly, this is the Sharpe ratio of the global markets. And the first expression can also be rewritten. Let's do that. This is equal to covariance of I with respect to GM divided by standard deviation of the global market into standard deviation of I multiplied by standard deviation of I. We have just multiplied the same thing in the denominator and the numerator. So the entire expression remains the same. Multiplied by Sharpe ratio of the global markets, right? We are just dealing with the first expression here, friends. Look at this. This becomes equal to, in this three expressions, the first expression is actually the correlation between I and the global markets. multiplied by the standard deviation of the market segment. The standard deviation of the market segment multiplied by the Sharpe ratio of the global markets. Right? This is for the first expression. We have just modified the first expression. Second term and the third term together we have multiplied it and modified it to become this kind of a term. Right? Correlation of I with respect to global market, standard deviation of I into Sharpe ratio of the global markets. Now the second one can also be modified, friends. The second one will look like this. Now the second expression had these terms. Let me write them. Beta of I with respect to itself multiplied by equity risk premium of I. Now this is equal to, if you write it in the brackets, this is equal to covariance of I with respect to I divided by variance of I. And the second expression is equity risk premium of I. Right? Now this can be rewritten, friends. This can be rewritten as covariance of I with respect to I divided by standard deviation of I, and the second expression becomes equity risk premium of the segmented market I divided by standard deviation of I. Right? We have just taken the square and put it in both sides, bifurcated it into both sides. Now this can again be rewritten as covariance of I with respect to I divided by variance of I multiplied by the standard deviation of I. We have just multiplied on the numerator standard deviation of I and on the denominator standard deviation of I. This is what we have done. The expression remains the same, right? Now the third expression becomes this multiplied by the Sharpe ratio of the segmented market. The Sharpe ratio of the segmented market. Right? You can see these expression, the first expression and the second expression is coming closer together. Standard deviation of I into Sharpe ratio of I. Right? This is what it comes down to. Now we can rewrite the Singer-Trerard equation like this. Equity risk premium according to Singer-Trerard model is equal to, the first part is the level of integration multiplied by the correlation of I with respect to global markets, I with respect to global markets, multiplied by the standard deviation of I, micro market I, multiplied by the Sharpe ratio of the global markets. This is the first part. And the second part is what? The second part is level of segmentation. Level of segmentation, which is 1 minus phi, multiplied by the standard deviation of I, multiplied by the Sharpe ratio of the segmented market. Now this is how the entire expression looks like. So let me highlight this one also. This is another form. Actually this is the form which is applied in mathematics. And generally many times it may so happen that only one Sharpe ratio is given. So in that case you have to assume both Sharpe ratio of the global market and the Sharpe ratio of the segmented market are the same. It can happen during application in a problem, but it may also be given separately. In that case you have to apply them separately. So this is the expression for Singer-Trerard model. Right, friends? One more thing we have forgotten during the discussion of Greenwald-Kroner model is that the time horizon we have not considered. So let us discuss that once. So in Greenwald-Kroner model, the time horizon that is assumed is generally infinite. The time horizon is considered to be infinite. But in infinite time horizon, certain changes have to happen. For example, the actual change over a perpetual period of the PE ratio is 0 because it will mean revert from above average during expansion to below average during contraction, to again above average during expansion, to again below average during contraction. Like this, it will keep on reverting, and ultimately the net off will be zero in the long run. Same will be the case for the percentage change in share outstanding. This will also be zero, because we consider in perpetuity there will be share issues and share repurchases both, right? Then the percentage growth rate of earnings over the long period should be equal to the nominal GDP rate. The nominal GDP rate. Here the context is obviously a country or a nation. So we are talking about GDP of the nation only. So it will be over the long period nominal GDP of that nation. So these factors will be the changes when the time horizon is considered to be infinite or perpetual. So Grinnell-Cronin model, expected return of equity over very long horizon or very long time period is equal to dividend yield plus GDP nominal. Now we'll talk about the risks of investing in equity of emerging markets. So the risks are very, very similar to what we discussed during fixed income investments. Fragile economics, obviously there are disciplinary issues. The resources might be concentrated. The economics might be much more unstable. Lower degree of information efficiencies. The markets have much more higher degree of opaqueness. So opacity is more. The information transparency is less, and obviously the efficiency is also less. It can be a combination of transparency and liquidity both, that the markets are inefficient. This can happen during emerging markets. Obviously not all the emerging markets will be like this, but these are the points that one has to check while making investments in emerging markets. The third point, political stability issues. Coalition governments, political instabilities can persist, so one has to check that. Policy issues. There can be policy fragility also, policy weaknesses also, bottlenecks also, policy instability also, right? That has to be checked also. Weak legal protections. Legal structures may not be well established, which means any investment made there, any contract signed there may be weaker in their protection levels. Law enforcement issues. The laws may be written down, but the infrastructure of enforcement may not be adequate. Then, corporate governance issues. Obviously, this can relate to things like corruption, things like lack of proper skills, or both. Inadequate property rights. This is again an aspect which combines policy issues, which combines legal protection issues, which combines law enforcement issues. Inadequate property rights. That you purchase a property, you purchase an asset, you invest in an asset, but the contract is not abided by. This can also be happening. Nationalization of companies. Because of inefficiencies, the companies may be nationalized. Nationalized in turns can breed inefficiencies. Seizure of property. Due to geopolitical reasons, due to economic reasons, due to reasons of corruption also, there can be seizure of property. There can be seizure of property. So these factors have to be taken care of. Questions need to be asked on each of these points, that are these things happening? Is there a scope of this thing happening in the future? All these things have to be taken into account when you are trying to invest in emerging markets. Again, not all the markets are going to be like this, but certain markets might be like this. So better check out all these points when you are making your investments.
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovision. See you in the next class.